All right, welcome, Giuliano. Really pleased to have you here to talk about investing. And you cover a lot of names, not just SoFi. So we're going to talk about SoFi specifically, as well as some long ideas, which I thought were really original. Really enjoy getting into that, and then your life as an analyst. So I have a special other guest with me, which is my SoFi shirt. You can see that.
That's great. I don't know one of those, but I'll have to, at some point I'll have to make the investment there.
Well, it's a tad cheaper than the price of SoFi stock right now, by the way. So it's on sale. This is priceless, actually. This might be worth more than SoFi stock. Now, look, by the way, full disclosure, like I've been bearish on SoFi. Everyone knows that. I'm going to do my best to make the bull case for SoFi. And engage in a Socratic dialogue with Giuliano. Giuliano's a pro. He's going to introduce himself now and talk about CompassPoint. I know quite a few hedge funds use CompassPoint research. So even if you guys aren't familiar with them, you should tune in and pay attention. So with that said, Giuliano, do you want to introduce yourself?
Yeah, and obviously, thank you so much for having me, Ram. It's great to have productive dialogue and kind of help get the thesis out there, and obviously have an intellectually honest debate and engaging discussion about SoFi and potentially some other names on the long side. To give you a little bit of background, I'm a senior research analyst and the managing director at CompassPoint. My core focus is specialty finance, which is kind of consumer finance, mortgage, with a few fintech oriented names in there, and I also cover a handful of special situations type names. Just to give you the cliff notes on CompassPoint, and then I'll expand a bit more on my background. CompassPoint is a full service investment bank that was founded in 2007 by Scott Dreyer, who used to be at FBR before that. And if you think about the firm, our primary focus historically has been on financial services and related sectors and policy research. And so that's to give you a quick background on where we are. We obviously have a decent policy focus since we're based in Washington, D.C., and that adds a lot of value to the fundamental discussion when you can overlay an interesting policy piece.
I've always enjoyed your research. There's been great alumni like Michael Tarkin, who's gone on to the hedge fund land, and Isaac Boltansky on the policy side. So it's an institution I follow for quite a while. By the way, I would encourage folks that have questions, they can type them in and comment here, and we'll do our best. I think, we'll do some three-parts. Start with SoFi, long ideas, and life of an analyst. And what's your life look like? What do you look for in businesses and your investing philosophy there? So
and I think,
go ahead.
And what I can do is I can give you a little background on myself, more specifically, which will probably feed into that point. So, I've been a sell-side analyst or associate since 2011. I worked at a firm called Collins Stewart for just under a year, supporting a pay TV media analyst. Then I joined BTIG in 2012, and I worked at first with two different teams. One was more of a pure special situations team that did anything and everything. It was things that you wouldn't follow, the things that were complicated, like Cheniere Energy before it was even an LNG export business. An LNG export business. It was just a regas business at that point, applying for permits.
Natural gas export business.
Yeah. So back then it was anything and everything. The special situations was undercovered, complicated. We looked at the Caesars bankruptcy, American Airlines bankruptcy, and a handful of situations like that. Then there's a financial services team that I supported where we primarily focused on what I'd say companies name situations that had a post-financial crisis hangover. So it was AIMBAC coming out of bankruptcy, CIT out of bankruptcy, looking at a lot of the monoline insurers that had a lot of legacy RMBS litigation. So I have a bit of a hybrid background where it's credit equity, and that kind of flows into my work today, where I focus on a lot of what I broadly call specialty finance, which is more value than growth in general, but there's obviously some growth. Take a name like a SoFi, obviously fits into that growthier category. So it's mostly consumer finance, mortgage, and some fintech related names. But I also steer a little bit further off every now and again and look for special situations, because I'm more than willing to roll up my sleeves and dig into a credit situation or something that is very complicated where everyone else is running away, and that's usually where you find a lot of the opportunity. So complexity is often my friend and what makes things interesting.
Well, we have that in common. We both like complexity. I was going through your reports and analysis, and your tolerance for complexity is higher than most. And look, SoFi's accounting requires a PhD, so we're going to get through some of that. Look, let me start with the bull case for SoFi. Like, SoFi is the future of finance. Banks are going digital. Banks are shutting down bank branches. We live on our mobile phone. They've got 3 million members across the United States. They're sponsoring a stadium. I know FTX did that too, but this time it's going to work. Look, people are raving about SoFi online. People wake up and they're cheering for SoFi, and the Noto went to West Point. Management's always delivered. They've always hit their numbers. And SoFi, after 3 years and having acquired a bank charter, is now GAAP profitable. So, they're going from 0 to 60 cents earnings per share. And the opportunity ahead of them is tremendous. They've got Technesis, which they acquired from Latin America, and Chris LaPlante, the CFO, shared that they intend to sell this to large banks or regional banks, which makes this a real tech platform play and deserves a tech premium. And also, the mortgage market, their penetration of the mortgage market is very small. So it looks like they could take on Quicken here. I mean, it seems to me like growth lights out. What an opportunity ahead. Where am I going wrong on this, Giuliano?
Well, I think what's important to take a step back. I mean, and be intellectual on this. I mean, what SoFi has done is impressive in many ways, and there are some nuances to that I think are relevant. I obviously have a bearish view, and I have a sell rating and a $4 price target, so I think that they can probably inform my perspective and my view on the stock. But when you take a step back, you have to think about what SoFi is today, and what they're becoming. SoFi is a bank, so that's not something that we can lose focus of, because SoFi is doing a few things that are unconventional. What I mean by that is specifically what you highlighted. They have an interesting technology segment that is growing, close to 20% on the top line. They have Galileo and Technesis. Those are very interesting businesses. Those obviously are interesting contributors to both growth and margin and earnings power over time. And they're businesses that the way that I would describe them are capital light, or really don't necessarily have capital, in the sense that they probably don't have any tangible book value or any material tangible book value. But then again, it's important to look at that and say, and take a step back. In my experience, and looking across around the market, over the past decade plus, SoFi is not the only financial institution, or what I would call balance sheet intensive or capital intensive financial institution that's had a tech segment or a non-financial business that is affiliated with their platform. And you don't usually value those independently. The way that I typically look at it is that you think about the contribution from that, and that is significantly accretive to your return on capital and your earnings, and that obviously should flow into your valuation from a price to book value or price to tangible book value, depending on how you're looking at it. So I think that's one important point. Then if you look at what they've done, it's been very impressive. They've grown their balance sheet from a de minimis amount to, obviously this is kind of on a gross basis, including intangibles and goodwill, but their balance sheet, they now have just over $31 billion in assets. But if you go back to the beginning of 2022, or even the beginning of 21, they had a $9.2 billion asset balance sheet. So they've effectively tripled the balance sheet in a matter of a few years, and they've done a lot of interesting things on the personal lending side. On the student lending side, they've grown a lot, but that in and of itself, growth is not everything. And the accounting is obviously something that makes the appearance of SoFi's numbers and what SoFi reports, difficult to compare. And that's obviously something that we'll get into, is that there are some alarming trends, with what, in a sense, what the optics look like versus what the underlying numbers and data is showing us related to their performance. And I'm happy to dig into anything specifically. You brought up mortgage and a few other topics there, but I'm really happy to dive in.
Sure, let's do it. Let's start at the high level. So look, analyst consensus estimates are going up. They're now GAAP profitable. So why can't we just slap a multiple on that earnings per share and give them a premium for the technology story where they're selling, tech to banks and payments to different players?
I mean, so a rough analogy I would use is if you were to take a slight step back and look at SoFi in terms of where SoFi is trading today from a valuation perspective, the stock is at, call it $6.50 is where I have it on my screen. On a price to tangible book value, SoFi is trading at about 1.68, call it 1.7 for rounding, because the stock's obviously going to move intraday. Whereas, their primary peer is trading at 0.78 times tangible book value. So they're effectively trading 2.2 times the relative valuation versus LendingClub, for example. LendingClub does not have a tech business, but then the question is that is trading 120% more expensive reasonable? And then that brings us into a different discussion. is the number that we're even applying, the tangible book value number, the right number to look at because of the differences in accounting that obviously shift, the appearance and, and the way the numbers would appear.
There are two stories there. One is, hey, look, this is a bank. Let's use tangible book value and let's comp it to peers. And what you're saying is more expensive to peers. By the way, it's more expensive than even banks like JP Morgan on a price which have, strong balance sheet, high ROE and growth. But the other side is, look, maybe price to tangible book is the wrong metric because this is a business that's going to enter hyper growth. And therefore, we should give this business a high forward PE ratio.
So I think there's a part of that that's obviously reasonable. And it's important to look at things in every way if you're going to stress test, in my case, a bearish thesis. But I think if we took a step back, I think the underlying question in that would be if the core bank, excluding the tech business, is worth roughly the same as LendingClub, for example, at 0.8 of tangible book value, is the rest of the business worth 1.4 times tangible book value, which is already what's implied. If you were to separate them completely and try to completely parse them apart, and that brings up a very very interesting question. But that in some ways, if you look at it through that lens, that would be effectively making the argument that SoFi's tech businesses are worth $5.7 billion.
Right. So what you're saying is
which would be a very which would be a lot of value, and that's in some ways, if you looked at it through that same lens, you'd be putting a tremendous amount of value on those businesses. And I think we can debate whether or not they're worth in a number in the high $5 billion range.
Right. And what you just said there is, hey, look, let's take a sum of the parts approach. Let's put tech in one bucket. Let's put the classic banking and lending business in another bucket. And what you're saying is the implied value of tech business has to be $5 billion and change, given the current valuation. By the way, there's another stock that's publicly traded. I don't own it, but I look at it, met the CEO, admire the business. It's called Encino, ticker NCNO. It's got a forward PE of 46, and it has a market cap of $3.6 billion, and they have real revenue, and they're growing quickly. So you've got to believe that the SoFi tech business is worth more than Encino, which has demonstrated product market fit and has sold into banks large and small.
Yeah, and I think when you take a step back, I think it's what does make things a bit more complicated is when you have a business as part of a larger entity like a bank. And in the case of SoFi, is that there is what they report as kind of directly attributable expenses or kind of direct business expenses. So they give you a contribution profit, which is effectively a pre-tax number if you put it through that lens. But what we also don't necessarily know is if you took my model, for example, or my estimates. I mean, I have just over 138 million of contribution profit this year for the tech platform. But if you were to take that a step further, that's not including a lot of stock-based compensation that's at the corporate level that's really related to this platform. You also have, in my model, 250 plus million of employee expenses. You have a lot of other corporate and unallocated expenses. So you have many hundreds of millions of dollars of expenses that are at the corporate level. And I think the underlying question here is, what is the actual underlying profitability of the tech segment if you were to run it as a standalone business and not just a division within the company? So that muddies the waters. But if you looked at what's kind of implied, if you took the current numbers, it would imply at 5.7 billion, that it's trading at over 40 times pre-tax income based on my estimate for this year.
Yeah, what's interesting about SoFi is like the balance sheet and the cash flow statement and like the footnotes that are required to really understand what's happening, with the business. Like the primary driver of growth for SoFi has been the personal loan business, and they've grown that to like a $15 billion size, and they started to curtail the growth of that in part due to conservative economic projections around the consumer. How should we think about the valuation of that personal loan book, and how does it contribute to SoFi's market cap? And I guess one other data point there is, we started to see some negative fair value adjustments. And look, there's a lot of accounting terminology in all of this, which can make this a subject matter that's difficult to unpack and explain. So maybe talk about personal loans and the valuation and how fair value fits into this.
So I think what you're hitting on two different things. If you look at the business, the primary source of growth and the primary source of both revenue and profitability growth at SoFi by leaps and bounds is the personal lending side of the business. And so that's obviously relevant. When you look at that business, I mean, they originated 13.8 billion last year. I have them originating, around 14.25 billion this year. From in my model, if you look at the principal balance on balance sheet, they have 14.3 billion, and they have those marked, at a total carrying value of 15.06 billion.
So that's how they value. You say that's what it's marked at. Right. And these are unsecured personal loans.
These are unsecured personal loans. If you took a step back, I think the point that you're kind of starting to move towards is, the topic of, making the fair value election, fair value accounting. SoFi has their personal loan portfolio as of the end of the first quarter marked at 104.24% of unpaid principal balance. So effectively, they have a $608 million cumulative fair value adjustment that's based on using the fair value election and then running a DCF model to value the loans at fair value. I'm more than happy to dig into that topic and provide some of the nuances there, if that's helpful. But you let me know where you want to go, so I don't want to jump too far.
Let's do that. So how should one value a personal loan book? Ultimately, if you're going to value something, you want to know what the cash flow stream of those assets are, and that cash flow stream is going to be the interest income, or they call it the coupon, less the cost of servicing, should be kind of small, minus expected defaults. That gives you the free cash flow. And then you discount those cash flows for each period in time in the future by an appropriate discount rate. Is that the right way to think about this?
That's a very good way to think about it. Maybe what's helpful is to take a little bit of a step back. When a bank or financial institution originates a loan, from an accounting perspective, they have two primary choices that they would make when they account for the loan. The first one would be to account for the loan at amortized cost. And if you did that, what you would do is you'd effectively take a $100 loan, put it on your balance sheet at 100, and you would then take an allowance for loan losses to cover the lifetime losses. There's some very slight nuances to that, but in this situation, that's probably, if you took a company like a LendingClub, that would probably be somewhere between 7 and 8% upfront. So effectively, you'd originate a $100 loan and take a 7 to 8% day one, provision for loan losses, and you'd effectively have the loan marked at, call it 92 to 93. On the other hand, the second choice would be fair value, to elect the fair value option. And what you would do there is similar to what you were saying, is you would effectively run a discounted cash flow analysis on the loan and the portfolio of loans you're originating. And you would effectively NPV that based on your projections for the lifetime cash flows, which is duration, credit, timing, et cetera. And you'd apply a discount rate to get to a loan value. The premise of fair value, or the intent of fair value, is to effectively mark the loans at the value at which they should trade or they should transact in the market in an arm's length transaction. And so when you look through that analysis, that is the goal of fair value, is to effectively put a market value on the loans. If you look at SoFi's case, the current portfolio is marked at 104.25, or 104.24. We're splitting hairs there.
That means 4.25% above the principal balance.
That's right. So
they originated a loan, and they're saying that loan is worth more than the amount they disperse to the end customer. How does that happen?
So, and I would make one nuance point there. If you look at the portfolio that is currently on the balance sheet, that's a seasoned portfolio, so it's already realized some of its cash flows. We don't know the exact seasoning, but my estimate is that you probably have 6 to 8 months of seasoning on that loan portfolio. Could be a little more, could be a little less. So you've already realized some of the cash flows. So the newer loans that they're originating that should have higher coupons, should be relatively better credit, underwriting, because they've made some changes to the underwriting model for the last few years. Probably, based on my estimates, could be marked as high as 107 or 108, and could even be higher in some cases. So when you look at the loans, the difference between fair value and amortized cost, which is the way that most financial institutions account for their loans, could be that the same $100 loan would be, if you take an example, would be a company like LendingClub, where most of the loans that they hold for investment they use amortized cost. Their loans would probably be marked at 92 or 93 day one versus a $100 loan, whereas SoFi, based on my estimates, would probably be marked at 107.
Right. So these are two different.
You could easily have a 14 or 15% difference day one.
Right. So under the fair value approach, which SoFi takes, and most financial institutions and peers of SoFi do not, so that creates some complexity here. They originate a loan. That means they make a loan to a borrower. Let's say it's a $20,000 loan, And then on day one, they say, hey, that $20,000 loan is actually worth 4% more or 8% more on their balance sheet.
That's right. And that would be, that additional value would be recognized as revenue immediately. Whereas using the other methodology or amortized cost, you'd recognize an expense day one.
Right.
That's the important thing to say is, I mean, I'd say two different things. The lifetime economics or the lifetime accounting for the loan from a profitability perspective will be the same over the life of the loan, no matter which accounting methodology you use.
It's sort of cruel.
So the difference though can be wildly material in the sense that you're effectively pulling forward your future earnings when you're using fair value, and then we can debate the accuracy or how justifiable the marks are. But if, in a sense, if you take my estimates and something I've published on many times in the past, and you took SoFi's portfolio and then you removed the there's, as of the first quarter, 856 million of accumulated fair value, and then you apply the CECL estimate that's roughly in line with peers and similar assets, my tangible book value per share number would go from 387 down to $1.88. So $
3.87 per share down to $1.
So $3.87 would go down to $1.88.
Got it. So about $2 will get chopped off if you use the same accounting framework that others. So under amortized cost, just again some accounting jingo. This is conceptually similar to like depreciation. It's really a cost allocation exercise and using a model-based framework to allocate. What you're not doing is valuation. Same when you buy a house, you depreciate that house over 29 and a half years per the tax code. It doesn't mean that your house, if it's an investment property, you're subject to enjoying depreciation then as a benefit.
I would say actually the biggest difference is that under the new accounting rules or using CECL, which came out a few years ago, the biggest difference that I think is important to distinguish is that the intent of CECL is to effectively take the expense for lifetime losses immediately. So effectively, you've covered your lifetime losses, whereas fair value doesn't have that nuance, and you wouldn't be effectively expensing your lifetime losses immediately. But after today, in a sense, we originated the same loan under both methodologies, you'd be wildly profitable under amortized costs going forward. Whereas I could argue that even based on current cost of capital and expenses.
So CECL is current expected credit losses. It's a new accounting framework that was introduced a couple of years after Dodd-Frank, right? Do you want to introduce what CECL is?
So in a sense, the biggest change with CECL is that there used to be more of a model or an estimated framework for taking an allowance for loan losses, where you kind of took estimable loan losses, and there were some nuances and some differences between the way some companies would look at that. What would the coverage be? Would it be 12 months, 18 months, 24 months? We could debate. There were some points that were debatable. Whereas under CECL, the intent was to normalize the accounting treatment and it also makes it more conservative, because what you would do is take the lifetime estimated losses as your allowance for loan losses immediately. You'd make estimates to the changes after that. But one thing that's important is that when you then, something that will probably come up later in this discussion is, allowance for loan losses are loss absorbing capital, which is not, in some ways you could argue that when you have a positive fair value number, you have negative loss absorbing capital on that loan.
Right.
Because you've actually taken the forward earnings and not taken the
the simple way to think about it. With CECL, you take your lumps up front. When you originate a loan, you recognize on day zero the expected expenses over the life of the loan, including those losses.
It's really just the losses and maybe taking an accrual for some marketing expenses. You don't take the other aspects into account there. But the way I would describe it is, if you took, as an example, and I realize that I'm picking on LendingClub here more specifically, but if you took where LendingClub has their loans marked using this framework, I would argue that book value or that value has positive forward value because they haven't pulled forward, and if the loans are arguably probably worth more than where they're marked. Whereas if you took the fair value approach, you've already recognized all that and pulled it forward. So that book value, even if you ran the current cost of capital and things like that, cost of servicing, estimated credit, I could argue that, even based on the current numbers, for SoFi, that, the actual accounting return for those loans would probably be negative in the future, or, flat to negative.
Right. So ultimately, you've got an accrual, which is an accounting concept that's designed to match revenues and expenses. But these two approaches ultimately will wash out over time, especially as the cash flow comes in from these loans that were dispersed.
I think that's right, but I would make one very big nuance there. If for one loan over the life of the loan, that's true. But, I'm borrowing some of the terminology or descriptions that others use, but a lot of people refer to fair value as a treadmill that, keeps on accelerating that you have to keep up with. So while that may be true today, looking at the portfolio over the life of the portfolio, that would even out. If you assuming you're continuing to mark loans at a positive fair value going forward and you continue to grow, you're just going to continue to grow the amount of positive fair value that you've accrued. So in some ways, while that's true for one loan over the life of the loan, it's wildly different, going forward. And I would argue that it actually compounds the difference over time rather than reduces it.
Fintech VCs know this. I haven't found a fintech VC that owns SoFi stock. By the way, I agree. SoFi has accomplished an incredible amount to take this to a public company too. So all the credit to them and the folks participating. But so look, if they can grow and they can generate revenue from growing originations and a 7% revenue recognition above the loan amount they dispersed, then that machine works as long as it can keep growing loans. Then that fair value dynamic works. And then if the public markets value on a price to sales ratio, I don't know if that's appropriate for a bank. You're saying price to tangible book.
I wouldn't use a price to revenue or a price to or an EV to revenue type multiple. And the main reason for that is if revenue is a bit of a fungible and interesting concept when you talk about financial institution, because if they were making worse quality loans that were subprime and had a higher interest rate, the same amount of loans would generate more revenue. Would you think that's more valuable or less valuable? I would argue less valuable. So revenue is an interesting concept because we're talking about a spread business and a margin business. Lending is one of the only businesses in the world where you sell your product or you originate a loan today and you don't know what your expenses are.
Discounted cash flow. Everything comes back to discounted cash flow. I don't think anyone would dispute that. It's just a question of when those cash flows show up and then what's the appropriate discount rate. But the basic idea is like under the treadmill concept, hey, if you originate these loans and you can keep growing the loan origination, you can keep growing revenue. Now, SoFi has curtailed the origination in their most recent quarters. That's number one. So that treadmill has stopped. And number two, we're also seeing for the first time negative fair value adjustments.
So I would split that a couple different ways. And I think there are really two topics there. One is a bit complex, and it's, are the fair value marks appropriate or reflective of what the loan should be worth? That's the first topic. And are the estimates that underlie that framework, accurate? And are they actually reflective of the price somebody would pay in an arm's length transaction for those loans? And then the next one is in some ways revenue recognition and how all that has impacted their financial statements and their reported financial performance. I think those are two very interesting topics because one of the things that you've seen, and this is something that we can obviously get into, is that if you look at the personal loan side of the business, as an example, going back, one of the important factors to think about is, where you're pricing, what your discount rate is, which is effectively a proxy for the yield that should be generated on the loans if an investor were to purchase the loans at the designated price or the estimated price. And the benchmark rate for personal loans is to your SOFR. And if you look over the last few years, the spread assumption that's embedded in the discount rate for SoFi's personal loan portfolio has gone from 5.94% at 4Q in the fourth quarter of 2020 all the way down to 1.25% in the first quarter of 24. And there's slight rounding because they report their discount rate to the nearest tenth of a percent, and then obviously going to the nearest hundred.
SOFR, that's the new LIBOR, the new way to think about like risk-free rate, short duration basis that typically banks charge.
It's effectively the risk-free reference rate for those securities.
Correct.
And if you think about a yield asset or a loan, the way you would think of what you would demand for that loan is a spread above that. So a secured loan should have a lower spread, whereas an unsecured loan should have a higher spread on a relative basis. We're talking absolutes here. So then if you were to then dig into some of the estimates, what I would say is a fairly big difference is that, take two companies that are originating what I would view to be very similar quality loans. LendingClub on one side, they're selling loans and using a discount rate of about 8% for their personal loans, whereas SoFi is using a discount rate of 5.8%, which is substantially lower.
Right, and that's the all-in discount rate, right?
That's the all-in discount rate, which would be a rough proxy for what an investor should generate based on the estimated prepayment speeds, credit losses, etc.
And what are mortgage rates in the United States now? 6%.
You're in the high 6% range at the moment.
So high 6%, but surely SoFi has a reason for using a lower discount than a mortgage rate, which is fully collateralized by a house. I mean, how do you justify a discount rate that's lower than what Fannie Mae or Freddie Mac
or what the public markets would require?
What the public markets would use to discount an asset-backed loan, namely your house. Go ahead.
When you take a step back, there's a lot of different indices that we can look at. The rough reference index is 2-year SOFR for personal loans. It's going to be different for different. A mortgage loan is going to be in a different place on the curve. Right. Just because it has longer duration. And obviously there's a lot of differences between the implied duration of mortgages. Yeah. But when you take a little bit of a step back, there is a fairly liquid market in the ABS markets. It took a little bit of a hiatus during COVID and is coming back slowly, but there is a liquid market for asset-backed security or securitizations, and specifically the senior tranches of securitizations, where you're seeing the A notes and sometimes you have an ABC structure. When your A note or your senior paper in those securitizations is usually, call it 70 to 90% leverage on the loans, and those are pricing around 225 basis points above 2-year SOFR at the moment. And those are securities with CUSIPs that trade if they don't trade daily, they almost trade daily, and they're actively traded and actively priced fairly often by different issuers. So we have a rough sense of what a non-bank would have to borrow at to lever their portfolio to get an acceptable levered return. And most of the structured investors they're looking at these transactions want a mid-teens levered return.
So what you're saying is, hey, if you look at the senior bond and a securitization, that means it's protected via subordination, credit enhancement, over collateralization.
That's right.
Last in line to default, and they are rated. They're rated by Moody's. SoFi's bonds are rated. And those are good bonds, by the way. I got no issue with SoFi senior bonds. Now,
and they're secured and they have credit enhancement because they're lending at less than 100% of the value of the loans.
That's right. Others eat their losses first, and that bond is last in line. So now you're saying, hey, look, SOFR is what, 530 bips today, 5.3%?
So 2-year SOFR is, if I look at it on my screen, in this very second, it's about 455.
And 2-year is what is it again?
455.
455. Okay, got it. And the senior bond has a spread over SOFR of what, 225 bips?
Roughly speaking, 225 basis points. And I'm making generalizations based on
So if I add those numbers together, if I add the spread,
roughly 6.8%.
So you get 6.8%. So how is SoFi discounting their personal loan book at a rate far lower than what the capital markets are using to discount the senior bond? And by the way, the senior bond has less risk in the personal loan portfolio, meaning the spread above SOFR on the personal loans, wouldn't that be higher?
So I think that I think we're getting into the crux of a few different things here. So SoFi has reduced their spread assumptions over time, which has had a significant positive impact to both revenue recognition, profitability, et cetera. And that is an interesting topic there around the first quarter results and kind of what I forecast for the year. So what's implied by the current, I think there's an important thing when we're talking about the discount rate. It is a calculated, it's a calculated and estimated number as of the end of the period. So this would be as of March 31. But if you were to take it as of today, it would imply that senior paper is probably priced around 6.8%. Different issuers are going to have different specific rates. It's not going to be exactly the same for everyone. Some are better issuers, some are worse. There will be some variation there. So I think the question would be, if you take the current discount rate, it wouldn't make sense for a non-bank buyer of let's say SoFi loans in this case to purchase their loans at the current valuation, 104.24, assuming we're at March 31 here, and then go to market and have to lever those loans with leverage that's effectively 1% higher from a cost perspective, because you'd actually get a negative impact due to your leverage. if you even take that a step further, there's a lot of pushback because taking it to like a LendingClub that has very similar quality collateral, and I mean, I could actually argue that they've probably actually gone upstream and are probably originating better collateral now, whereas SoFi's probably gone a little bit further downstream in terms of the type of loans and the quality of loans they're originating. They're selling loans, close to an 8% unlevered yield. So, and they're transacting much more often, in the market as opposed to one-off, negotiated transactions. So that is creating a lot of pushback because when you look at the revenue recognition, that's driving a tremendous amount of additional pull forward for SoFi that's positive. They wouldn't, in a sense, they wouldn't have been profitable last quarter had they been using an 8%.
So let's touch on this point here. How much management discretion is used in the determination of the discount rate? Is that not promulgated by FASB or the SEC? Who sets that?
So I mean, there are obviously FASB rules around fair value and the way it should be recognized. There are nuances. I mean, if you look at disclosures, I mean, it is a topic that gets a lot of scrutiny from an audit perspective. Almost every company that has loans at fair value has some sort of disclosure about enhanced scrutiny of fair values. You obviously have to have a process in place. You have to back test it. You have to provide some support. Where I think things get a little bit in a sense where some people push back on SoFi is that the discount rate seems lower than structurally senior and secured paper that's credit protected on the same assets. And even if you look at their financial reports, and I put out estimates in the past, they provide financing for the purchase of some of their loan sales, and based on my estimates, they're charging around 6.2%. So I think the question, if you look at,
I want to make sure I get that straight. So if someone buys a SoFi loan, and SoFi's a bank, they've got cheap deposits, they can finance that. They can finance it off their balance sheet, as they should, and they understand the collateral. Why not, right? But they're charging a higher interest rate to finance SoFi loans, and they discount their own loans on their balance sheet.
So if you were to take a step back, I mean, in the fourth quarter and in the first quarter, the numbers are roughly similar. They're right around 6.2%, depending on how you calculate. It might be 6.3%. My estimate is that the leverage that they're providing to whole loan buyers themselves, as part of some of the whole loan sales that they're doing, they've done both the fourth quarter and the first quarter, is that they're charging roughly 6.2%. There is a mix of both quarters, and we go with the first quarter, but the discount rates that they use on the underlying loans in the fourth quarter was 5.5% and 5.8%. So in a sense, if you were to take a step back, what that implies, intuitively, is that, based on their analysis of the loans and their forecasts, they're getting, the purchase price reflects, that yield. But what it also implies, though, is that the loan buyers, or that if anyone purchased the loans at those prices and had to lever those loans at 6.2%, that they would probably get a negative impact of leverage. They're actually better off not taking out leverage.
Got it. Well, what about these? Look, they've been doing these secondary sales to validate that they can recognize a gain on sale. Look, and I apologize for people having to navigate the accounting on this. You need to be like a CFA or PhD or at this point, or having grown up at banks to understand this stuff. But SoFi has said, look, we've done secondary market transactions to validate the marks on our books. Have they not? Why aren't those marks sufficient?
So I think that there are obviously very important nuances to that, because every loan should be valued independently and and separately. So loan A and loan B are not the same. One thing that we do know, if you look at their portfolio, if you look at some of the loans that they've securitized, there's some Fitch press releases about some of the last few securitizations. The loans that they're selling, or at least they've securitized, have had yields of about 14.5%. The yields on the balance sheet have effectively flatlined, plus or minus a few basis points the last few quarters, at 13.8%. So what's clear is that the last few quarters they've been originating loans with, based on my assumptions, about 14.5% average coupons, but the yield is not increasing on their portfolio. And what that implies is that they're actually selling newer loans that have realized less of their lifetime cash flows and have a higher yield. So when we're comparing the two loans, just because you sell a loan at 105 or 106 that has different characteristics does not mean that the other loan that's on the balance sheet is worth the same amount.
You could sell a newly issued vintage of loans at a higher price because it's less seasoned, hasn't gone through the J curve of losses, and they're charging a higher coupon, higher credit quality. But it'd be wrong to imply that the loans on the back book deserve the same valuation. I think the other thing is, it's worth asking, like, how many of these secondary market transactions have happened relative to the size of the portfolio? Is it material?
I think that's a relevant question. And then there's even more beyond that, because that's in some ways, that's not everything. Because then, one thing that the company has references that they've provided, some sort of loss sharing arrangements as well. So there is some loss absorption by SoFi on the back end.
Right.
Well, and those can be structured in a variety of ways. But what's difficult to tell is what is that included in their framework or not, or is that a separate thing that doesn't really impact the analysis of the loan price or the loan value at transaction? That's very complicated. Then if they're also providing, in a sense, if they're also lending at 6.2%, for the last couple of quarters, I would argue that that's below where the market is pricing similar securities. So that is somewhat circular in the sense, if you provide advantageous financing for your loan buyers to lever the portfolio, that's also value that's being transferred, in a sense, from to the loan value from the loan that's being made or the secured loan that they're providing. So it's a lot more complicated than that, but in many ways, I would say, and I engage with a lot of investors who buy whole loans or involved in the ABS markets. I mean, what they mostly say is, personal loans are, pricing in the 8% yield unlevered at this point. And I haven't found anybody that has said they'd be willing to buy personal loans with a 5.8%.
It makes sense. I mean, these loans are unsecured personal loans, and if you look at all the obligations a consumer can have, mortgage, people don't want to default on. Auto, they got to drive to work. Cell phone, they need to get work and do the work, call their friends and family. So the bottom of the payment priority stack, well, even credit card people they want the rewards points, they want convenience, pay for things on credit card and Apple Pay. The first thing that people default on is the unsecured personal loan. So, SoFi has taken very conservative projections, they say, around 7 to 8% expected loss. We have this question.
Life of loan, yeah. And then there's some nuances to that. But I mean, what I think is interesting then, if you look at the numbers, what you've actually seen is that their charge-off ratio and their delinquencies have been, increasing rapidly. There is one, it's important to.
Can you quantify that?
So if you were to look at, there's one nuance. Last quarter, they did a delinquent loan sale that in a sense transferred some of the NCOs away, which just really reduced the reported number. But I obviously estimate, what it would have looked like otherwise. If you look at their charge-off ratio in all of 2022, it was 1.86%. Their charge-off ratio in 2023 was 3.42% on fair value. It ended in the fourth quarter, I estimate 4.05%.
And that's on the total loan book.
The first quarter, that's the annualized write-offs in the quarter. And in the first quarter of 24, if I were to add back the defaulted loan sale the late stage delinquency loan sale, I estimate 4.91%. That's on fair value. So that is over 104 and change. So if you actually look at that on average principal, my estimate would actually be higher. Last quarter was about 5.34%. And if you look at their estimate in the fair value analysis, they're estimating 4.8%. And if you look through the details a little more, in the finer numbers in the queue, it seems like it's closer to 4.85. But that is on the fair value, so that actually comes out to just over 5% a year.
All right. So you're seeing some realized annual default rates that are north of what management has been saying, which is around 4.8. But I also heard this number about 7 to 8% over the life of the loan. Can you distinguish between those two metrics? So
what you're going to have, I mean, the duration of loans moves around a bit, but roughly speaking, on average, personal loans, your typical prime personal loan portfolio usually has a 1.5 year duration. So if you had 5% average annualized charge-offs per year over 1.5 years, you get roughly 7.5%.
Right. And just a quick definition. So duration is the weighted average expected cash flows. That's the way to think about duration. So, if I make a loan to someone and they agree to pay back in 10 years and they make one payment in 10 years and the duration on that loan is 10 years. So, if you take a 30-year fixed rate mortgage, because people refinance mortgages, or they used to when rates were lower, more quickly, even though the contractual duration was 30 years, the weighted average life of a mortgage was actually closer to like 3 to 4 years. So that's the definition of duration for those that are following. So SoFi's average duration is 1.5 years.
Yeah. And one thing they've said recently, just in the interest of is that some of the newer loans are slightly shorter duration. So the relationship between the 7 to 8% life of loan might be a little different. But if you took things a little bit of a step further, what you've also seen, and there's obviously some mixed components that play into this, is that the 90 plus delinquencies have increased fairly materially, and you've increased from the third quarter of 23 at 48 basis points, you increased to 56 basis points in the fourth quarter, and then 72 basis points in the first quarter of 24. If you took historical roll rates, based on my analysis at least, that would imply your charge-off ratio should be north of 6%, and on fair value, and potentially north of 6.5% on principal in the second quarter. So which would be a fair amount above what they're estimating, which is roughly 5% a year.
So if I take that, so they've got this stated 7 to 8% life of loan loss. You're seeing 6% DQs, delinquency. Go ahead, yeah.
So what you're seeing is 72 basis points, and if you looked at what that would imply based on the historical roll rate patterns, that would imply that the next quarter's charge-off rate should be north of 6%. So in order for 5% to be the right number, if they do end up at over 6%, they would have to end up below 6% at some point on the loan portfolio that they're analyzing.
Right. So it looks like the 7 to 8% life of loan loss assumption will not be met, even though they've stated that they've. Go ahead, yeah.
I think there are a few things. There's what I think seems fairly clear, and they provided disclosures here, is that a big part of the 2022 and before vintages have underperformed on credit. They're fairly small, but if they're really driving the overall portfolio this much, my assumption is that they're underperforming by a lot. They provide some relative disclosures around how much better some of the recent vintages are performing versus the third quarter of 22 vintage. What we don't know is how much that those previous vintages are underperforming, in the sense, are they 50 to 100% over, and are they 20 or 30% better? Because that would still put them above. What we don't necessarily know is where they truly are. They've obviously reiterated the 7 to 8% target, but if you look at where they are, I didn't have credit getting this bad. I assumed that credit would deteriorate, but I didn't have them anywhere near this level of deterioration in my forecasts, for many quarters leading up to this. So I think credit has, been a negative surprise for me, at least.
Right. And what's your price target on SoFi?
I have a $4 price target, and a sell rating, obviously. One topic that might be worth kind of touching on related to this whole situation, because it kind of gets back to they're GAAP profitable, they're still growing revenue, things are still moving in the right direction. We can obviously debate capital, book value, and things like that. But one thing that does create a lot of that doesn't necessarily get picked up is that SoFi has loans at fair value, and they mark them to market every quarter. And they make changes to spread assumptions. They also hedge the portfolio, and the goal of hedging the portfolio is so that if your fair value went up by 1, your hedge should go down by 1. It's imperfect historically. When you look at that relationship, it's never perfect. The market and hedging is never a perfect 1-to-1. But when you take a quarter like last quarter, they did a couple things. They roughly cut the spread assumptions on the student loan portfolio by almost 50 basis points. And they also cut the spread assumption on the personal loan portfolio somewhere between 15 and 20 basis points. But when you think about that, because they're hedged, what that effectively did is they recognized a lot of hedge gains when interest rates went up. But because they cut the spread assumptions, they didn't have a perfect offset. So the loans didn't go down by as much as they would have had they not touched the spread assumptions. And my rough estimate, that I've published, is that had roughly $125+ million impact specifically in the first quarter. So if you think of that, intellectually, that's not really economic earnings. That's really model earnings. That's the company made changes to the assumptions, and that arguably drove $125+ million of positive revenue.
By changing assumptions, you can grow earnings.
So if you look at a quarter like last quarter, where they, the core earnings outside of the convert gains and other gains that they had was about $22.5 million. But if that included, based on my estimates, $125+ million of one-time events. And if you were to look at an analogy, and I would look at it 2 different ways, their mortgage companies have MSRs, and they've marked them to market every quarter. Typically, with the mortgage servicing rights. And what they typically do is they effectively back out the model-based changes to fair value every quarter, because those can be fairly large, from their economic earnings. So when they report an adjusted EBITDA or an adjusted net income number, they would effectively back out those gains or those losses in the quarter to provide more of a steady state reflection of cash flow or underlying earnings. So in this case, the argument I would make is that SoFi is also selling loans and recognizing recognizing personal loan servicing rights. And when there are variations quarter to quarter in the servicing right value, which is effectively the fair value premium, they back that out, positive or negative, from revenue, EBITDA, not net income. But then the equivalent fair value premium on the loans, where they've effectively made increasingly aggressive assumptions, so they've effectively pulled forward even more earnings, is driving a lot of those numbers, but those don't get added back or removed from your revenue or EBITDA, or even your net income. So it creates what I'd say is kind of like an uneven treatment of the same thing, or inconsistent treatment. But when you look at it through that lens, the interesting point that I would make is, and I wrote a report, which is almost entirely to this on this topic, was that while they hit the guidance from a reported perspective, taking my numbers, obviously, I estimate that there was $125+ million of positive, estimate driven changes, relative to the hedge based on, changes in the assumptions. They reported $580.6 million of adjusted net revenue in the first quarter, but based on my estimates, that would have been $455.6 million, which would have been down significantly quarter over quarter, and would have been down year over year.
Down significantly quarter over quarter if they had a consistent treatment.
If they had not changed their spread assumptions.
If they had not changed okay, that's interesting. So in other words, like when we think about SoFi as a business, so levers are: do you grow personal loans? Do you sell more to banks? Do you take in more deposits than go finance other assets? But one of the other key levers driving earnings is the spread assumption. And the impact of that spread assumption is to the tune of $400+ million, which is enough per quarter.
When you look at it through that lens, my rough estimate is that the model changes in last quarter were roughly 22% of revenue, if not more.
Right.
So then there's a question of, there are a lot of people saying, well, they're growing revenue, they're now profitable. But the quality of the revenue and the earnings, in my opinion, has actually deteriorated materially. You're seeing credit deteriorating. You're seeing, what I would call like one-time event earnings that are model-driven as opposed to economic, impacting your revenue, EBITDA, and profitability. Right. But if you just looked at the numbers, through that lens, the perspective that I'm, laying out there, 22.5 million of positive net income in the first quarter would have been negative 102.5 million. Your EBITDA of 144.4 million would have been 19.4.
So this is your answer to the question of, well, Noda always hits his earnings.
Well, I mean, at the end of the day, they have to have a justification. There's
right. They got
to get to the estimates. But when you take a step back, here's what's important. The quality of those earnings has deteriorated based on my estimates. In order for them to even hit their guidance for next quarter and the full year, they would need more of that. I have 80 million of estimated model gains next quarter and 25 in the third and fourth quarter to get to their guidance for revenue, EBITDA, and everything.
Well, let's shift.
In my opinion, the quality is deteriorated materially.
Right.
So quoting revenue becomes increasingly less,
relevant,
impactful.
It's not SaaS revenue. But okay, how about the tech business? And we talked about how if you value it according to other comps and some of the parts base might be lower, but isn't the future tech, like what's wrong with the story, if any, of SoFi selling to banks? So Chris LaPointe, the CFO, last week at a conference said that, they're in RFPs with multiple large banks, to compete with Jack Henry, Fiserv, FIS, and sell a banking core. Why can't that be a great business that saves the day?
So, I mean, I think it's definitely a very interesting business, and it definitely adds value to the SoFi story. And if you were to say, how would you value SoFi with the tech business versus without, you'd value them higher with the tech business. So there's obviously contribution. There's a lot of positive benefits from the tech business. The key challenge here is that you're still part of a bank. So it's going to come down to what return on capital can you generate, what return on tangible book value or ROTC can you generate, return on tangible common equity, and then what multiple do you ascribe for that? And your tech business should be accretive to that, as it already is, because it's accretive. It is generating positive earnings contribution at the moment. Then we can get into a larger philosophical debate where the book value that you have at is not necessarily equal to others, because you've already pulled forward $850 to $860 million of future earnings, and you also arguably haven't taken over $1.2 billion of credit loss estimates, which also significantly impacts your capital ratios. So while they do have a great CET1 ratio, and their CET1 ratio is 17.1%, if you ran that same pro forma analysis, and if they were using without the fair value premiums and with CECL reserves, my estimate is that 17.1 would be 10.4, and that by the end of this year they'd be at 9.1%. And by the end of next year, my model, they'd be at 7.2%, and that would actually continue to fall.
Right. What do you think about the NBA sponsorship? That's not going to save the day by growing new accounts.
Well, I mean, at the end of the day, I think they're obviously spending a lot of money on marketing. You obviously have the management team that has a lot of experience, and arguably has a lot of relevant different experience that other financial institutions or bank management teams don't have. So it's interesting. I mean, everyone loves to throw out an analogy. At the end of the day, it creates a lot of viewership, it creates a lot of engagement and interest. They're obviously growing deposits, but deposit growth is a source of funding here. It's not necessarily it can produce some positive carry if they can invest or deposit that money and get a positive spread. Yeah. They have they're very well they have a lot of liquidity. They have a great they have an interesting deposit franchise at this point. But that brings up the question of yes, it's working. They have a user-friendly platform. They've brought on a lot of users, but at the end of the day, lending is a very unique business where you have to continue to underwrite good loans. And I think the question here is, while credit's deteriorating, have they really figured it out? Because it seems to have underperformed. How much additional value or revenue are they recognizing with fair value versus amortized costs? And then beyond that, how much are they, are their marks reasonable, and how much is that impacting their revenue recognition and profitability? Because if they were using an 8% discount rate, in my model, they would be unprofitable this year, and arguably probably next year.
Right. Well, is there anything that would cause you to change your mind on your assessment?
I mean, I think I think it's important to always be willing to step back. I think having real visibility into their ability to grow this business, and also have a sense of what the actual amount of capital required is to run this business, and that they can generate an acceptable return on capital, and that there wouldn't be any concerns that the marks are too aggressive, or that that the marks seem more reasonable. Right now, in some ways, what you're seeing is the underlying performance, in my opinion, at least on the economic basis, has completely rolled over, has deteriorated massively. The optics look good because there are changes in assumptions that are driving the numbers, making them look better. But that's optics, and that's not really tangible.
That's really the punchline of the story, is that, hey, if you change the model, you can.
So you'd have to really see credit improve, and you'd have to see them prove out, a lot of these different things. Then it's even justifying loan values. When you put together very complex structures where all the value is recognized on the back end through servicing and things like that, those aren't necessarily the best proxy, because the market, in my opinion, will always dilute the value of a loan sold at face value, and where all the economics are on the back end, and there's risk for prepayments and other events, even loss sharing, versus a loan that's sold at a premium to the face value.
Right. Great. Well, thank you for that topic. I thought it was enlightening. For folks that want to get more of the bull case, you can go online, Seeking Alpha, type in SoFi, take a look at data-driven investing. He's got some good write-ups on this. Look, I'm biased. I wrote about my bear thesis, really not even my thesis on SoFi. I was more like, hey, a few things don't make sense to me. After they reported in October, I said, SoFi is the one company in the world where their credit spreads tightened when interest rates widened and credit spreads widened in every known asset in the world, except SoFi. And that led me down this rabbit hole. And I said, this doesn't make any sense. And well, here we are. So, well, look, you also cover ideas on the long side. And I looked at some of your ideas there. Why don't you talk about your mortgage servicer play?
Yeah, so if you look through my coverage, I mean, one of the interesting names I cover is Mr. Cooper Group, and which formerly was NationStar before they merged with the legacy WAMU shell that had NOLs a number of years ago. But if you look at Mr. Cooper Group, what are they? They're effectively the most servicing weighted originator servicer in the market today, in my opinion. And they make most of their money from the servicing side of the business, and it's realizing the cash flows from MSR assets. If you look at that entity, you have a very unique setup.
Right. Real quick, do you want to define like what a mortgage servicing right? Like what is that business model?
So when you originate a mortgage, after the savings and loans crisis, what we did is we created something that's referred to as a mortgage servicing right. So when the government effectively took over a lot of failed SNLs, they suddenly had a lot of mortgages that they owned and didn't. The government's not in the business of servicing loans. So what they did is they created a contractual income stream that they could effectively sell or pay somebody else to service the mortgage, effectively collect the cash flows, remit the payments, and provide foreclosures, property preservation, and liquidate the property as needed, or if needed in a foreclosure event. What you now have when you originate a mortgage is that the value when you originate a mortgage is typically in the mortgage servicing right. The actual cash that an originator generates is usually slightly negative when they originate a loan, and almost all, if not 100% of the positive value is usually created in a mortgage servicing right, which is the cash flows that you would be paid, or the estimated cash flows that you would be paid as to service the loan.
It's like a royalty
expenses and everything else.
Right. It's like a royalty stream.
It's a rough concept, but those are also valued at fair value and mark to market every quarter, just like the way SoFi's loans are.
Right.
But when you look at that, there are a couple interesting trends. You have a much larger portion of the market that is further out of the money than we've ever had before. So the cash flow stream is very long duration.
Meaning they cannot refinance their mortgages.
When you look at a lot of the MSRs that Mr. Cooper has, they have 3%, 4% type coupons. So even if interest rates came in 1%, there is very little incentive for the borrowers on those mortgages to pay their mortgages early. If that were to happen, that would actually reduce your cash flows. So you have very long duration assets that are out of the money, that are now hedged when you think about Mr. Cooper, and you have a company that has a target ROTC ratio or target between 14 and 18%, wants to run the business with at least a 20 or 25% tangible net worth to tangible asset ratio, which is effectively CET1, and they're actually north of 25% still.
Core equity tier 1 capital, which is a statutory.
They're a non-bank, so they don't have a regulatory capital ratio the way a bank would have in a CET1, but it's a rough proxy for that. And if you look at the business, on top of that, you have an interesting macro event where banks continue to be net sellers of MSRs. Smaller non-banks are struggling, so they're selling MSRs. And Mr. Cooper is the most efficient servicer, has the best cost to service, has a very stable balance sheet, a hedge balance sheet, long duration cash flow assets, and is the best buyer of assets. If you look at the market, historically, you've probably transacted somewhere in the range of 500 to 600 billion of MSR UPB, which is the unpaid principal balance of the mortgages, not the actual asset value per year. But the projections are that we're actually going to be transacting $1 trillion plus per year. And the buyer pool is very narrow. So you have an interesting story here where you have a mid to high teens ROTC, non-bank financial that doesn't have deposit risk. They obviously have wholesale funding risk that has minimal near-term interest rate risk, and they're also hedged on top of that, and has a very interesting cyclical growth opportunity that I would argue is unique.
If rates are higher for longer, they benefit.
They should continue to benefit, they should continue to buy and purchase MSRs and scale up their earnings power. So you have an interesting, you're not just playing a micro theme here where the company, in my opinion, is extremely well run. You also have the benefit of a macro theme behind you where you should have an interesting growth story on top of this, and you're getting a very attractive return on tangible common equity. And that is a big part of the underlying, my underlying buy rating and $97 target here is that you're not just making a value play, you're making a play on an extremely well capitalized and overcapitalized entity that's taking advantage of a macro theme and has a lot of stability in this interest rate environment. And I would argue it actually benefit if rates came in a little bit, and it's hard to replicate that in the financial world today.
Right. I like that thesis. Look, the two risks are that the wholesale funding, which you pointed out, because they're non-bank, they cannot finance with deposits. So if capital markets shut down, for example, the securitization markets, or they cannot access, corporate debt to finance new purchases of MSRs, which is their growth lever, then earnings would slow down. But if wholesale funding markets shut down, they can still make money.
Yeah. I would argue there are a couple of things. I mean, if you think about where they are, at the end of the day, if the capital market shut down, there's a recession. We always make the argument that everything goes down. That's kind of a flippant answer, I realize, but it's important to step back. This is arguably one of the best capitalized entities, has some of the best margins, has a tremendous amount of liquidity. So if you were to say, who's probably going to have, problems first, it's probably not the Mr. Coopers or most of the public companies. It's probably some of the privates that have much more private funding. They also have a fair amount of term on their unsecured debt. There's obviously renewals that would be needed for, different financing structures. But when you look at the underlying collateral, the interesting question would be, what is the value of the underlying collateral? And when you ran into issues around and after the 0809, the GFC, most of the problems that mortgage servicers had with MSR funding actually came from non-agency. It was legacy PLS and non-QM MSRs and originations, whereas the vast majority of this balance sheet is GSE, Fannie, Freddie, and Ginnie Mae MSR, and GSE MSRs. And Ginnie Mae MSRs. So it's a very different.
Is that the
it's a very different risk profile,
right?
Where
what I like about it
is much more valuable.
What I like about it is like a few things. One is servicing is a hard business in terms of technology. You need specialized players. There's Ocwen, there's Nelnet in student loans, there's Navient, and so you need good technology. You need specialization. 3, there's regulatory scrutiny. People aren't getting up trying to start a new mortgage servicer business. But if you can own a chunk of the market with a large TAM and have a competitive edge on acquiring other MSR pools and finance that at a lower rate than the return you're getting in the MSR pool, you're capturing that spread just like a bank. Ideally, you'd have secure, stable funding on the borrower side. They don't have that here. They are relying on capital markets, but there's no run on the bank.
They've done a great job with their maturity schedule, though. So I don't necessarily think that they're the first line of companies you'd be worried about. What I would also say is that a lot of the MSRs that they're investing in, and I may butcher the exact numbers here, but the spread at which they're investing new capital today is far greater than it's historically been. So in a sense, they're roughly funding the balance sheet at around 7%, or funding around 7%, and then they're deploying capital at 13 or 14%. So you probably have 6 to 7 points of spread, whereas
they're capturing that spread. As long as they keep buying up these pools, then
whereas a few years ago they were funding at 9% and buying pools at 12. For example. So their spread was probably high 2s to 3s.
What rate would cause this thesis to unravel? Like, what mortgage rate would you need to see for us to walk away from that opportunity?
You'd have to go back. I mean, in a sense, a very large portion of the portfolio will most likely not be in the money to refinance in the future. You'd have to see rates come in materially to really create a problem here. Or a recession would be the other question here that would cause more foreclosures.
You're taking
your cost of servicing increases. You have more outlays in terms of advances, so it's much more expensive to service loans that are delinquent or need to go through foreclosure. That would be margin dilutive. You do have an offset that I didn't necessarily haven't necessarily pushed on, but you do have the originations platform that's mostly internally focused here. But when rates come in, there's a lot of origination opportunity for refinancing, cash out refi, among other things.
What I also like about this opportunity, I have to dig in myself and do more homework. I think it's interesting. Is first off, like the forward PE is 8.1 times when the S&P forward PE ratio is 21. And look, you can make money in value stocks. You look at this as a classic example of that. The stock has performed 70% return in 1 year, and it still has a PE ratio of 8. So there's plenty of opportunity.
And I think what's in some ways underappreciated, and it's an argument that I've made before, is that you had a generational event in the mortgage industry during 2020 and 21, where you effectively had incredible earnings generated by the sector because origination volumes and margins were at incredible levels for the industry. So it was both this is a pro-cyclical industry where margins and volume tend to go together, up and down. But if you were to look across the industry, the only company, in my opinion, that I think will be able to surpass their peak earnings from 2021 in the near future is Mr. Cooper. Because while they generate, they have a more stable earning stream because they're more focused on servicing rather than originations, or more, or less up and down, upper and lower boundaries. They're able to grow materially. And if you look at, 2020, they generated, $9.34 of, fully taxed operating income. But if you look at my model, I mean, I have them generating $10.36 in 24 and $12.47 in 25, and then $15.26. The issue I run into from a modeling perspective is what do they do with all the excess capital and capital they're generating?
Buybacks, pretty simple. We got a good answer for that one. Or buy more, but
or grow faster.
Or grow faster. So let's. I have my friend Jacob Park we're going to bring on here. That was a great thesis. Thank you, Giuliano. So I'm sorry to double back just a bit on SoFi. Jacob, I've got you on stage here. By the way, so a few months ago, I was digging into like all these like what I view as like these fake profiles of SoFi 007 girl. You DM them and no one responds or they block you. Are there real people or is this investor relations in the modern era where these social media bots? Jacob said, I'm a real person. We got him in a Zoom call. We chatted that night. I kind of like poked him. He poked me. We're like, all right. And I heard his thesis. He heard my thesis. We've stayed in touch since then, exchanged ideas regularly. So Jacob, thank you for joining.
Thanks for having me.
You bet. You heard the case. Yeah. What are we missing? What's the hole in the argument? What's the rebuttal to the SoFi bear case?
Well, there's a few things that I would talk about. One, you were talking about the quality of the loans, but I make 6 figures. I have a 780 credit score. They were still denying me loans, where LendingClub actually was like giving me a loan. So right there,
I think that's a very good point. And I think and as an example, I think my FICO score. I did a similar example. I went and applied, for a loan. I think I applied for a $40,000 personal loan. Yeah. Without giving you specific numbers, my debt to income ratio is extremely low.
Right.
I have more than the loan amount in cash, in my checking account. I have an 8. I think my FICO was around 830 when I applied. I was denied a loan. So I was then referred to LendingClub and others. I think that's a very good point and it's relevant. But I think when you take a step back, it's important to then look at the performance of the loans. Because they don't, it's not necessarily linear when you look and compare the numbers versus other lenders because they're circling through they're cycling and selling. They're also they're growing faster for a while, and there's a huge denominator effect. Mm-hmm. What's interesting though, if you were to compare them to let's say a LendingClub, the loans are obviously different. SoFi's average personal loan is in the $30,000 range, whereas LendingClub's by mid to high teens. Okay. But if you've actually seen, you've seen an inverse pattern where SoFi's FICO scores have gone from the 760s and down into the 750s and then potentially a little below. I can pull exact numbers and send those over to you. I don't want to misquote them, live. Whereas you've seen the opposite of LendingClub where they've gone upstream and they're effectively in a similar bucket, slightly different income ranges, but also different loan values. Right. So I think the ultimate question here is we're debating prime versus super prime and 2 companies that are on the edge. Right. So yes, the loans are good quality. They've also pulled back. Then the underlying question is why did they pull back? And you're obviously seeing that there's been some credit underperformance with previous vintages. So that's what people do when they've obviously made some mistakes in the past. Is it fatal? No, but right. In a sense, are they really that different? They've made mistakes like a lot of others. They've done some things better. They've done some things worse. But in a sense, does it make it something that is that much incredibly better? I have a hard time saying that it's really a true differentiator.
Gotcha. Well, I think they've articulated pretty well that like they were slowing the lending or just keeping it flat right now. And they were transitioning into making their growth come from the financial services and their tech platform, right? And as you know, they've guided for 80 cents per share 2026, right? So
there's a range for 26.
Yeah. It was a range, but they've always beat and raised, right? So that was without any new product lines. And at that Fireside conference, it kind of sounded like LaPointe was honestly sandbagging. That's kind of what their whole plan has been the whole time.
You're saying they have a track record of beat and raise, so why don't we say they'll do it again? Yeah. Noda went to West Point, and I guess if you go to West Point, then you always beat and raise, and right.
Yeah. Well, so if you go back, I'm not sure if you listen to the full
I was listening to the
discussion that we've had. In a sense that you had a beat and raise last quarter, mm-hmm. but a very large percentage of that wasn't really economic revenue or earnings. So in some ways, beat and raise, and that's a very interesting. It's an interesting point because in my opinion, they beat and raised because they made more aggressive assumptions, which are really uneconomic earnings. They're not really earnings from that period. They kind of stole from the future and pulled it forward and plugged it into the period in a sense. That I'm using that as like an analogy, not saying they literally stole. But in a sense, the impact.
Those guys went to McKinsey and Goldman Sachs.
Yeah.
By the way.
Yeah. But in a sense, so I was saying, are you saying that that's going to continue into 2026? Like, so if they make 80 cents per share, you think that it's just it was aggressive and it pulled growth from forward?
So in a sense, I struggle to get anywhere near that in the model. without making very aggressive assumptions on growth or where they're marking loans day one.
So they've repeated it over
model,
and over again. So what do you think that we're missing?
And I think the other thing to consider is also, it's nice to have projections and forecasts, but I think what's also relevant is that, and hopefully not misquoting the exact numbers, but it seems like what they've been, referring to is 20, maybe up to 25% growth for the technology platform. I'm already there or above that in my model. Mm-hmm. And you referenced the financial services segment. One thing that I think, and that's a very interesting topic and question, but when you look at this company and you take a little bit of a step back, the financial services segment last quarter generated, and if you look at revenues, I'm in the pull up the spreadsheet here just so I can give you a slightly more accurate representation. Is growing revenues materially, but the vast majority of those revenues are not because of the financial services segment, in my opinion at least. What they're doing is the way that they're effectively categorizing is that the financial services segment owns the deposits and the funding and then lends them to the lending segment. So when you look at the non-interest income, what you've seen is that the net interest income is skyrocketed at the financial services segment, and that's driving the vast majority of all the revenue growth and profitability growth. But if you were to kind of unpack that, they do report the interest recognized for the loans in the lending segment, so we can get a rough proxy of what the amount of interest the lending segment is actually paying to the financial services segment. And based on my model, in the first quarter of 23, they paid 145.7 million in interest, and that increased to 333 million. So if you were, gross revenue versus net revenue, because they're reporting on a net basis, but the vast majority of the growth in the financial services segment is being driven by the lending segment. So in many ways, it's a different segment, but it's really just shifting revenue that is really lending over from one side to the other. At the end of the day, your deposits and your loans are all part of the bank.
But the contribution profit of the lending side is still, high and growing itself too. So even if that's true, it's accelerating as fast as it's going, and they're guiding for it to continue in the future. What's the problem?
At the end of the day, it should all be put. My argument is that it should all be put together because you're really separating two parts of the same thing by separating the segments. So, in a sense, the part of the reason why the growth should be stronger there versus the lending segment is because you're shifting more from lending to financial services. So, in some ways, it's really the same thing. But what that also comes back to is that when you think about the growth needed to get to where they want to get to in 26, the majority of that growth is from them becoming even more of a bank and becoming even more of a personal loan and student loan focused entity.
Actually, I thought about that.
So in a sense, because it's all the same, what we're really saying is most of the growth, the tech platform is interesting. It's generating a lot of value. It's growing. That's great. That's all great for SoFi, and it's a positive for the stock. But most of the growth is still coming from lending and becoming more of a bank and more of a consumer bank and more of an unsecured personal lender and a student lender, among other things. And they obviously,
but they're guiding for the opposite. They're guiding for the tech and financial services to become a larger piece of the pie.
So I think I'll try to avoid going in circles on this, but my argument is the financial services segment is really is the bank. It really is the lending business. So if you look at what's in financial services, there's 30.8 million of non-interest income in the first quarter of 24. Almost all the interest income is bank. It's making loans, it's senior secured loans, it's lending to loans. Of that 30.8 million, you have roughly 25 or so million. I'm rounding a little bit. That is that is interchange, which is related to being a bank. It's the interchange on credit cards, debit cards. You then also have referral fees on the turn downs from the lending segment, so the loans that they turn down. So in a sense, when the two of us both applied for a loan on SoFi as an example to test it out, we probably were then sent to Upstart, LendingClub, and others, and those companies pay a fee for that, which is really still associated with lending, which is a big chunk. And there's 4 to 5 million of wealth management fees, or brokerage related fees, which are part of a bank. Almost all large banks have some sort of brokerage or wealth management. So my point is, whether it's financial, in a sense, the company likes to look at financial services and tech together as the growth engine, but at the end of the day, in my opinion, financial services and lending should be put together, and tech should be separate.
Yeah, I
in
hear
a sense, most of the growth is still coming from the combination of lending plus financial services.
I hear
which
you.
is
And
still,
another piece of that
and the
is
underlying part of that is lending.
and I hear you there. And another part is they actually gave us a little piece of how long it takes for the tech deals to close, right, at the last conference. And if they're guiding for this in a couple of years, it tells me, I don't know about you, it tells me that they already know some of the revenue that they're going to realize, when some of these deals finish that we don't know because they can't disclose them yet.
I mean, at the end of the day, just like all of us, they're making educated, forecasts. They're obviously
they're
indicate the
insiders,
pipeline is,
obviously.
yeah. I mean, in a sense, it's important to try and be as intellectually or honest as you can. They have reaccelerated revenue growth in a sense. Revenue growth, even excluding, internal, revenue from selling SOFR internally or recognizing revenue internally actually went negative. Growth is reaccelerating. They're signing more deals, but in a sense, even if you took my forecast, I have them getting close to 30% growth in 2026 and continuing to grow margins. So I'm giving them credit for a lot of that, in my opinion. So I think the question is, could they increase the growth rate to, instead of my model that probably has them somewhere in the 25 to 30% range, could they increase that run rate to 30 to 35 or 35 to 40? I have a hard time seeing that. But I think,
so you're also assuming lending is not going to grow to fill the gap that you're missing, is what you're saying too, right?
So, I still have lending growing fairly significantly, and some of that is being allocated to the lending segment, from a modeling perspective, and I'm above, I'm above most of the estimates in many cases. I have credit completely normalizing. I have them cutting expenses. I have them reducing marketing expenses. The growth rate of all these segment level expenses running more slowly than all the revenues. I still struggle in the model to get anywhere close to that. And then the ultimate question over time will be what could get them there closer. In a sense, maybe they could sell more loans, or if they could significantly increase origination volume, that would be helpful. But I don't necessarily looking at it today, they are a very large percentage of the market, and I don't, in my opinion, I haven't seen a personal lender keep where SoFi is market share wise or higher without having significant credit issues, and even maintain that volume consistently. Nobody's been able to do that, so it's hard to say that they're just going to grow much higher, much faster.
The way you grow lending is you expand your credit buy box. You got to change your underwriting criteria.
In a sense, if they could sell more loans that they don't want to keep, that could obviously be value accretive with an efficient platform. But from a growth perspective, I have them growing north of 15% on origination volumes in both student and personal in 25 and 26.
So when rates come down, which I don't know how many you think we're getting this year, maybe one, maybe two, but next year after that, eventually they're going to get to where they can just cycle almost the whole loan book every quarter, like how they were doing. And with the amount of deposits they're getting, I think that it'll accelerate maybe more than your.
So I think that that's a very interesting. You're making an interesting point. I think there's an inherent challenge in that, and it's that it would only truly, in my opinion, it would only truly be accretive to sell additional origination volume that you can't keep.
Right. Yeah.
Because if, in a sense, even if you took the current portfolio, the current personal loan portfolio, and you sold 100% of originations this year, and let's say it's all 107, let's go way above where they're claiming they're selling from an execution perspective, and then just look at the expense base, your earnings would actually fall materially, because a lot of the value of the loans is actually the interest on the back end. So selling more and recycling it faster is not necessarily accretive. Having the balance sheet and leaving loans on balance sheet is actually more valuable on a relative basis.
Well, if they're able to, hold a certain amount and then sell, the rest of their what's it called? Their capacity.
Any excess capacity. And at this point in time, they have, from a capital ratio perspective, they have a lot of capital. They have a 17.1% CET1 ratio. The way I would look at it through a couple of different lenses, and I think where the discussion often goes with institutional investors is that if you think about the messaging and then also capital, for the kind of later in 23, they kind of pivoted from saying we're going to grow through 24 to saying we're probably not going to grow in 24. Then they did a CDS deal on $2.5 billion notional to get $2 billion of RWA relief. That's a capital relief transaction. Then they equitized a large portion of the convert, which is great execution. It's a great way of raising capital. But in some ways, they've done a lot of things where slow growth, do a capital relief transaction, raise more equity and capital, through a very interesting creative transaction that was much better than trying to raise equity in the public markets, in the sense of doing a traditional secondary, in my opinion at least.
Yeah.
But then the question becomes, by the end of 25, I'm back down to a 15.1% CET1 and then 14.1% in my model. If you were to look at them on more of an apples to apples basis, the end of 24, 25, and 26, versus a LendingClub where if I assume that they had, no fair value premiums, and on top of that, they didn't have, if they had, provisions, at the end of 24, I'd be at 9.1, I'd be at 7.2 in the end of 25, and I'd be at 5.8 at the end of 26. So in many ways, in my opinion, the only reason why SoFi is where it is today is because of fair value. And the only way that they're going to be able to get to where they're going is by not making any, not hitting any speed bumps and continuing to run along this course and, arguably, improve the way that, they're marketing loans as opposed to deteriorate. So that is something that becomes difficult. And then, what I would then overlay on top of that is in my model, my accumulated fair value premium, or the current total accumulated fair value premium that they've already recognized as of the first quarter is $856.5 million. In my model, that increases to 1.122 billion at the end of 24, 1.5 billion, and just over 1.8 billion.
Yeah.
So, in many ways, more than 100% of the earnings that I'm forecasting are coming from pulling forward earnings with fair value premiums. So that in some ways that also deteriorates the value of that earnings stream.
One other point
from my perspective.
I have on the screen here, I'm showing FIS. So there's FIS, Jack Henry, there's Q2. And look, there are these leading bank core providers. They're incredible oligopoly businesses. They're dinosaur companies, and they're entrenched in the banking sector. And you can see that stock price is going up. They make money selling tech to banks, these bank cores that SoFi is trying to enter the market in and trying to pull share away. So the point here is that like product market fit's hard. If you want to enter and compete against a bank core, many startups have tried and failed. Just haven't done it. Highly regulated category. Banks are conservative. Changing out your bank core is the last priority a bank ever has. Right now, they're addressing commercial real estate issues. They want to stop deposit flight. They want to make sure they can refinance their existing customers. And, those are their priorities. So,
I mean, there's also a lot of inertia when it comes to bank cores. I mean, an analogy, I don't currently cover the company, but we, and at a previous firm, I worked on a team that covered Q2, for example. And, they're a very interesting company. They were bringing a new product to, smaller banks and kind of a SaaS-based kind of like, complete bank core structure to a lot of community banks and smaller banks that had, disparate systems. They had a mobile system, an online system that didn't even communicate. And, they grew very well. I think that the underlying question is going to be, to your point, there's an oligopoly or duopoly, at the top for larger bank cores. And, banks are typically risk averse. And it takes a lot of time before, for a bank to jump out and say, I'm going to jump to this newer core that only a few people, are willing to adopt, today. So it's going to take time. They're obviously making progress and they're growing. They're making an impact. So, and that's obviously good. But, it can take some time. I mean, when you're looking through the RFP process, I mean, almost all the end customers should be looking at multiple providers and trying to get RFPs from everyone. Because we're talking about getting RFPs from, 5, at most, maybe 10, 10 on the outside, type of providers. So, it can take a lot of time before you kind of, work your way into that sector. I mean, obviously it's a lucrative business. If you can make your way in and grow, but it's important to then, look at that business appropriately. It is still part of a bank, and it's hard to give, at the end of the day, a sum of the parts valuation is always, aggressive by nature.
Hey, you got a question here, Giuliano. Why are you not posing your view or critique on the analyst call? Did they let you speak on that?
Yeah, I won't speculate, but for every quarter I've covered the company, I've entered the question queue.
And you don't get they don't put you on the field. I wonder why.
I haven't been called upon, to ask a question, and
maybe we could spend a lot.
I'd be more than happy to run some questions and ideas by them, so they can prepare answers appropriately. I've tried to enter the queue, but I haven't been called upon. We'll put it that way.
So I actually have a question. So your $4 price target and your sell rating, how dependent on that are defaults raising?
So in my
substantial
opinion,
amount.
my $4 target, I mean, I have defaults normalizing and recovering quickly, starting in the back half of 24.
Okay.
In order for me to get, so in a sense, I have things improving in the model. I'm trying to be fairly honest. I have yields improving. I have your spread, I have, cost of capital coming down. So I think there's, there is obviously directional benefits. If you were to assume, rate cuts, your deposit costs should reprice faster than your loans, just because there's more duration of the loans. SoFi at the moment is not fully benefiting from originating higher yielding loans because they're selling a lot of the higher yielding loans that they're originating on the personal loan side, and not, so that's probably the reason why, they've, at least based on the information that's out in the public domain, it looks like they're selling loans that have a 14.5% yield, but their yield's kind of been pinned at 13.8. So they're not fully benefiting from.
So you said you had a hard time getting to the 80 cents per share, like they were guiding for, but take a scenario. So if they do reach that or even higher, does your price target change right now?
I mean, at the end of the day, I mean, it's hard to, it's hard. I can't necessarily say like where my price target go in any scenario, but I think when you take a step back and you look at a company like this or a name like this, and you say, what is, I think the range was 55 to 80 cents, which, well, in a sense, like, let's assume that, I'm going to assume that that's the right range for now. They're also not currently a taxpayer. The average of that is, in the mid 60s. What would that actually be if you were a full taxpayer? Call it, so 23% tax rate, that'd be 52 cents. I think the question would then be, if that's where they end up on a fully taxed basis, you would be talking about a consumer-oriented bank that is, generating, a very low teens return on tangible equity, and that, I think that's being very optimistic. And a lot of banks, that they get profile are actually trading at trading below 10 times earnings. We could argue that maybe you could push it closer to 10 times earnings because there's a benefit to the business. Jacob, there's a tremendous amount of execution risk between now and then.
Okay, so I got to change topics too, Jake. So thank you for joining. I appreciate it very much. Good exchange. Until next time. So Giuliano, just to shift gears here, and maybe in the last 5 to 10 minutes here, I'd love to hear kind of your life as an analyst. What does day-to-day look like for you? How do you originate ideas? What's the coverage look like? What's the intensity? And what are the things that people just don't know about being an analyst? You touched on one of those, which is like, hey, you're in the analyst queue. You're like, can I get a question? They don't tap you in the shoulder. And, one of the realities is that investor relations, they cultivate analysts. And if you play ball, you get an early look, you get a preview. I know analysts that cover SoFi that have been invited to the CEO's house. Okay, that I'm sure that's still a professional relationship, but maybe the career path for an analyst to become a CFO, maybe ingratiating with management helps. On the other hand, if you want to join the buy side, I think your approach, stands to scrutiny. But I guess the question is, what's life like as an analyst, and what are the?
At the end of the day, no 2 days are the same. I spend a lot of my time going through filings, looking at information, paying attention to the news. I probably cast a broader net than some of my peers, but you learn new things by talking to people, looking at different industries, even meeting people outside of work who are in similar industries, like understanding how things are going. At the unit level, I try to I like looking into the complexity and trying to unpack everything myself. I think one of the challenges that a lot of people in the analyst seat run into is that they can become a bit too removed from the analysis or the numbers. I try not to remove myself from the numbers, because once you completely remove yourself from the numbers, I think the value of your analysis goes down. So the other part of that is that I'm engaging daily with it's rare that I don't engage with multiple people a day on the other side. Work at different hedge funds, mutual funds, you name it, family offices, etc. We're institutional investors, very smart. There's a lot of information being exchanged. People are meeting with management teams. People ask me for help with preparing for their meetings with management teams. I meet with management teams on my own. We're getting takeaways that can be applicable to the companies we're looking at, companies we're not looking at. My wheels are always spinning, and I'm always looking for something new and different. I'm always looking at new companies, new ideas, And sometimes it comes through an idea that somebody brings up to you, or you hear something from somebody else, and then you do your own work. Or in some cases, you roll up your sleeves. In the case of SoFi, I rolled up my sleeves. I saw that there was things that were a bit different going on. I tried to kind of unpack the numbers and figure out what was happening, and really look below the surface, because a lot of the commentary and the disclosures I think obfuscate what's actually happening under the hood if they look like everyone else. So a lot of it comes down to looking through the numbers, trying to take a step back, and even listen. There's a lot of things in conference call transcripts. There's a lot of things outside of that. I mean, you have to be a net, and you have to capture all this information and distill it down, and not lose the forest from the trees. There's obviously a fundamental argument. Fundamentals don't always drive the stocks in the near term. So it's also important to not only see the analysis and the fundamentals, but then also understand what's happening around you in the world.
Right. How do you think social media has impacted analysis and investing? Like, clearly, SoFi has a lot of social media around it. So do other stocks like Palantir, for instance.
I mean, I think it's the first thing I'd say is my Twitter feed's up most of the day on my screen somewhere. So I'm obviously following what's happening. I mean, news flow usually gets disseminated through Twitter, just as fast, or if not faster in many cases. So it's very interesting to have that feed up, because it's another source of information. So Bloomberg terminal, I have a lot of information it's flashing in my face all day long. But it's important to I think it creates an interesting debate and a way for in this case my clients are institutional investors. We're talking about fund managers. Fund managers are different analysts, portfolio managers at fund structures. In some cases, family offices and individuals who have very significant net worth. But when you look at the Twitter world, I mean, you have a combination of professionals who do this for a living, and you also have a lot of retail investors who are out there engaging. I think it creates a productive debate. I think some of it derails in unprofessional directions, but there's a lot of interesting information, takeaways, different ways of looking at things. And at the end of the day, even if you may disagree with the way that somebody's looking at something, if a very large percentage of the shareholder base is retail and they're thinking about something a certain way, you can't ignore that. It has to be part of your analysis and your opinion, because that can obviously have a big impact on where a stock would trade.
That makes sense. And what about you personally? Like, how have you developed as an analyst, and what are the learnings along the way that you're like, gee, I wish I knew that analytical technique that's reshaped how I think about investing?
And I think you keep learning every day. That's the day you stop learning in this business is the beginning of the end in many ways. You have to always be open to suggestions. You have to always be willing to change your opinion, because you can't get married to a company, a stock, or a call. You have to always be willing to stress test your own ideas. I think one of the challenges that you can sometimes run into on this side is that you're working on ideas and you're developing them, and you don't necessarily have a sounding board, because until you put out something new, you can't you can only bring up something externally once it's out publicly and been widely disseminated. So whereas if you were on the other side, you can have a half-baked idea and throw some things at the walls with your friends. So it's important to also be willing to stress test your own ideas, do your own work, accept pushback, from others, and even seek out the right pushback internally from people that can obviously see your ideas as you're working on them. So at the end of the day, it's a learning process. You have to keep being you have to always be willing to go outside your comfort zone, look at complexity. I think a lot of people get a little bit too comfortable with looking at the small group of companies they always look at. But what I always find interesting is pull up the documents, read some transcripts from other companies that are in completely different universes. Understand what they're doing, understand what the market's focused on. If you look at the market today, I mean, it's one of the most concentrated markets we've seen maybe ever, but at least in recent history, where there's a handful of companies that are driving the vast majority of the market at the moment. And that's not something you can ignore, the same way you can't ignore market structure and a handful of other things. So it's important to keep learning, and keep in many ways kind of keep innovating from this perspective.
Terrific. Well, I think we'll leave it there. Thank you so much for joining us. Really appreciate it. I'm looking forward to digging into.
It was a great discussion. I appreciate it on my side. Yeah. Thanks for having me.
We'll have to do it again. Until next time. Thank you.
Sounds good.